Hello, hello, hello. Hey, this is Rob Rosa, your friend in real estate. Hey, I'm coming at you live here today, having a little bit of espresso. I hope that you are having an absolutely marvelous day like I am. And one of the things that I wanted to go over with you today, and it's a little precursor, a little preview for those of you who are going to join me in the real estate class this evening, because we are going to discuss real estate appraisals. And this is part of our real estate education series. So if you want to get access to these, it's pretty easy. All you really have to do is visit us over at smartreadvice.com, and we will definitely have you subscribe to those. No cost, no additional expense on your part. If you like what you're hearing here today, go to smartreadvice.com. But at the same time, leave me a question. Leave me a comment if you want to. Hopefully I can see a lot of them live, not all of them. Some of them come across and some of them I see afterwards. But even if you just want to say hello or share it, that would be great as well. So let's today talk about some moolah, right? We're going to talk about the income approach, right? We're going to talk about the cap. You see me? The capitalization approach. And how does that help you? Because I talk to people every day who want to take a look at some multifamily properties. Maybe it's a 2-family, a 3-family, a 5-family, a 10-family, a 20-family unit. Maybe it's a mixed-use property that's generating some revenue. Could be a small strip plaza, right, that you might want to particularly buy. Have a couple of those. Could be a little industrial plaza that you want to buy. So I have quite a few different properties that are revenue generating that are available for you. All right. And so you, whether you want to buy it or whether you want to sell it, you want to know, hey, Rob, how much is it worth? Now, not to disparage appraisers, right? But you can go get yourself an appraiser and they'll give you an exact number at that one particular moment in time as to how much it's worth. Hey, Lindsay, thank you so much for joining us. Hopefully you'll be in class this evening, right? But you might, get that number. Oh, it's worth right now this amount. Boom, boom, boom. And that's fine. But guess what? What if you're looking to buy it or sell it in a month or 2 months or 3 months? And what if you're not sure how to market it? What's the best way? So these are the things we're going to talk about. So what we're really going to talk about right now is called the income approach. And when we talk about the income approach, there's an acronym. It's called GIVEN. GIVEN. 5, right? Number 1 is for G is gross. We're going to take a look at the gross income. All right. And what does that mean? We're going to take a look. I for income. V for what? Who knows? Vacancy. Well, how much vacancy does this particular property have? E is for expenses. What are the expenses of this property? We're going to take a look at that when we determine what the value of that particular property. And we're going to take a look at the net operating income. So there's really basically 5 steps that are taken. First of all, estimating the annual potential gross income. All right. And so how do we do that? We take a look at market studies. We take a look at, well, how much is the particular building or strip plaza or industrial building or mixed use? How much is it generating right now? What are the current market rental rates? Is it below the current market? Is it above the market? How does that potential income, what does it also include? Right? Does it include vending machine income? Does it include application fees? Does it include parking fees? Does it include laundry machines? Does it include garages? Does it include storage spaces? So there's a lot of different things that we can take a look at and try to figure out, hey, what does this include for income? And then we're going to deduct. Boo! Right? We have to deduct the appropriate allowance for vacancy. Okay. And so what is the number that you like to use? Is it 3%, 5%, 10% for vacancy? And then, rent loss, which basically will help us to arrive at the effective gross income. Okay. Hey, Jaja, thank you for saying hello. I appreciate you joining in on this, right? Number three, right, is going to be basically deducting the annual operating expenses from the effective gross income. So there's going to be a lot of different expenses that you have. Well, what could some of those expenses be? Might be taxes, right? Might be insurance. Is it going to be the mortgage? Let me take a moment, right? Enjoy myself. It's an absolutely gorgeous day out here today, right? I love my espresso. Is it the mortgage? No. Is it any kind of what would we call it? I guess we would call it capital expenditures, debt service. No, those are not part of or considered to be part of the operating expenses, because everyone who buys this property might buy it differently. You know, I know many of you out there, you might just go out there and buy this $785,000 4-unit commercial property in cash, right? You know, my wife might go out there and say, hey, listen, I got the cash. I'm going to just buy this. I don't have to worry about it. Whereas me, if I was going to buy it, you know, I might have to get a little bit of money from the bank, just a little bit, right? So those things like the mortgage payments, principal and interest, those things are not included. And then number 4 would be the wonderful world of the cap rate. And what is the cap rate? That's what gets people confused in many cases. So we're going to talk a little bit about the cap rate. We have a few minutes. I mean, unless you're in a hurry, hey, I understand. But I mean, I'm kind of hanging out here at the coffee shop, enjoying myself today. And so I thought it would be a good idea. Let's do a little bit of mentoring, Monday mentoring. So let's talk about the cap rate or capitalization rate, right? Basically, what we will do is understand and try to understand, hey, what amount of demand for the investment property will we have? Okay. We're going to estimate the price of that what a typical investor would pay for the income produced by this particular type of property. So we take the estimated return, right, or yield. That's what somebody might call it. And an investor would demand for the investment of the capital. Okay, so I know it kind of threw a whole bunch of words at you and really doesn't make any sense. So basically, what we're going to do to get that cap rate is we're going to figure out, okay, here's how much the income is and divide that by the value to get the cap rate. And technically, there's 3 different equations that we can use, right? And so when we're using these equations, we need to come up with one out of the 3 numbers. So what are those 3 numbers? We're always trying to figure out either number 1, the value, right? Or number 2, the capitalization rate, or number 3, the income. So between those 3 numbers, value, rate, and income, we can use the other 2 numbers to get the third. So let's say we don't know what the value should possibly be. Okay. So we figure out that this particular property has a certain amount of income coming in by month and then by year, net operating income. We're going to divide that by the current cap rate. Now in Harford County, okay, I just got the numbers off of my phone just about a half an hour ago. In Harford County, for apartment units and mixed use properties, Harford County, 5 units and up, we're talking about a cap rate of 7.19%. 7.19%. Okay, so if we were to figure out that this particular property, and I'm just going to do some basic numbers right now, has a monthly income, net operating income, let's just say of $5,000 monthly net operating income. Okay, after all expenses and so forth, that's what we get. So we take $5,000, and I got my little calculator here, times 12 months gives us $60,000. Okay, so that is the annual net operating income. And we know in Harford County, it's 7.19%. So we're going to do 60,000 divided by 7.19%. And that gives us a value of $834,492. Whoa, Rob, what are you talking about? What are you talking about? Well, this is just giving us a gauge. I mean, there's a lot of other things that come into play, like appreciation and so forth. And so the cap rate is not exact. But what we're saying is if this property has this net operating income after all expenses, except for mortgage services and so forth, has, we said, $5,000 a month times 12 months equals $60,000 of net operating income per year, right? 60,000 per year. And we know, and you can get this from your real estate professional. Let's say you don't know what the going cap rate is. Well, you can get this from somebody like me. Hey, Rob, what's the cap rate for this kind of property in this particular area? And we can figure that out. And we have different statistics and so forth that we use. Well, we know it's 7.19%. So I do $60,000 divided by 7.19% gives me a value of $834,492. So if you were going to be able to buy this property for less than that amount, you would be doing pretty good. You would be doing better than the average. If that property was on the market for $950,000 and we come up with $834,000, it's about $115,000, $116,000 too much, right? I mean, according to what the amount of income is generating. Now, there's other things that come into play and so forth, but you're probably paying higher than what the market should be demanding. If you were looking to sell the property, you would want to try to make sure you sell it for more than that $834,492.35. You know, I'm kind of looking at my calculator here. So hopefully that makes sense to you. So there's a lot of things that come into play. Again, there's three equations: the net operating income, the annual, divided by the rate, the capitalization rate equals the value. The net operating income divided by the value of the property equals the capitalization rate. So again, a little bit tricky, throwing quite a few things at you here. And then the value times the rate should give you what the annual net income is. So let's take a look at that. I think that one's interesting. Let's say you pretty much figure out that this property is worth $300,000, right? So you're like, hey, the value of this, I think, or maybe it's even on the market, it's listed. It's a nice little 4-family property, and it's listed for $300,000. Now, we know the cap rate is 7.91% here in Hartford County right now. So let's just use that. $300,000 times 7.19, right, gives us, well, really 7.19%, gives us $21,570 of net annual income. So that property should be making per year $21,570 of net operating income. And if we divide that by 12, there's $1,797. So you would figure that if you're going to buy a $300,000, that $300,000 4 unit, and the cap rate is 7.19%, you would figure that the total annual net operating income that you're going to make is $21,570. Is it worth it to you? Maybe, right? Might be good for your portfolio. And you're going to make almost $1,800 a month from that. So there's a lot of numbers that come into play. There's a lot of different things that we look at, even concerning a gross rent multiplier, gross income multipliers, and so forth. Remember, the higher the cap rate, right? Usually it's the higher the price or the risk for that particular buyer or investor. The lower the cap rate means it's usually the lower the price. And this is what even appraisers will use for, again, the income approach. So that's what I wanted to share to you today. Hopefully you learned a little something. Hopefully it might have opened up your mind a little bit, like, wow, you know what? There are some properties out there, some 3 units, 4 units, 5 units, 10 units, multifamily, little strip plazas, little industrial buildings that you always wanted to buy or take a look at and you weren't sure what's the first way to go about it. Well, video will hopefully help you understand about what it's worth or what you could possibly sell it for and what you need to look at for some statistics and some data, like again, the wonderful world of the cap rate. So thank you so much for joining me today. I hope you are having an absolutely amazing day. Subscribe, follow me over at smartreadvice.com. Feel free to call me, text me, email me about any particular property questions that you have. I'll get right back to you. I have that availability to do it. And again, God bless you. Rob Rosa signing out. Thanks. Bye.